Hey guys, so in this interview, I'm chatting with Poseidon Ho. He's a rising venture capitalist and founding partner of Outliers Fund. He's currently managing a $50 million Fund 3. And in this interview, I'm going to ask him what he's bullish on in the crypto space, what did he learn from the disasters of 2022, and his fascinating journey to even become a VC. Take a listen.
All right, I am so excited to chat with you today, Poseidon. And I think the first place I want to start off with is to pick your brain as a VC, because you study and analyze all sorts of niches and projects and whatnot. So I want to ask you, for these next few years, what areas are you most excited about?
Okay, this is a question that I've been asked every day by not only our founders, but also our limited partner, venture partner, ecosystem partners. In the past 7 years, if you ask me this same question, my answer will always be around infrastructure level research innovations, especially layer 1 protocols, layer 2 solutions, interoperability tools, dev tools, basically the missing infrastructure, like the operating system, IDE, the programming languages we need for Web3. But after seeing 2020 and 2021 with GameFi, DeFi, SocialFi, XRP, NFT, DAO being more materialized, I have a very strong gut feeling that the next bullish market will be driven by mainly Web3 social, content, metaverse, anything that can build brands, that can build communities, and that can build the infrastructure for metaverse, as well as innovative NFT use cases.
That makes sense. So let's just dig into one point you just mentioned, social, Web3 social. Yeah. There are some out there I've checked out before, but like, where do you see the problems in that area? Where do you see the opportunity? And feel free to mention specific projects too.
First of all, I would need to throw this question back to you. A tricky question that I ask a lot of Web3 startup founders who claim to be building the next generation of Web3 version Discord, Web3 version Telegram or Twitter. Like, how much do you think it costs to store 1 GB of data on chain, on Ethereum versus Solana, for example?
That's a great question. I bet it's like $1,000 or something on Ethereum, and probably like $1 on Solana is my gut feeling guess. I have no idea.
Okay, I have the most accurate answer that I done my actual calculation by end of 2021. So it's data dated a year back. I might need to redo my calculation again in order to give you the most accurate answer a year later now. But the research that I've done informed that it actually costs $72 million to store 1 GB of data on Ethereum directly, including all the gas fees. So, and it would take around 1 million to store it on Solana.
Okay.
And of course, the price of Ethereum and Solana have dropped significantly. So I think the price for Ethereum right now will be around 29 million or less.
Wow.
And the cost for storing that on Solana will be 400K or less. That's why this is a very good filtering question. If a startup founders come to me at any single random conferences, showing me like a video or an image and claiming that this is fully decentralized file storage store on there, I would ask him this question. If he or she is not answering anywhere closer to these double-digit million and several hundred K, it means that they have definitely stored their data directly or indirectly on AWS and Microsoft Azure.
Right.
They're actually only storing like a pointer or data container that links to their AWS account.
Right.
And
Makes sense.
that is one of the biggest secrets that a lot of NFT startup founders are not talking about these days, that they don't actually give you the ownership of your NFT. Actually, AWS, the ownership of your actual images, your profile pictures. You own the pointer that points to that
Exactly.
database. Yeah, so that's, if you ask me what is the problem of the SocialFi or Web3 social content products that I'm seeing in the Web3 space, that would be my most notable questions so far.
That makes sense. Have you thought a lot or looked into the Web3 gaming space a bit?
Oh, yes. Yeah,
Okay.
we have put a lot of thoughts into it. Yeah, what is your specific question? Sorry if I cut you off.
No worries. I just wanted to make sure you've kind of looked into this niche. So I personally think this space is promising, but we haven't really seen any games that can like balance the fun gaming part with the token NFT crypto part. So like Axie Infinity, let's be honest, it looks great. It's boring. It's so boring to play. And people do it because they can make money. So that was a big criticism of like play to earn gaming. So I guess just so let's start broad. Like, what are your thoughts on Web3 gaming space? Can play to earn work? How to best balance it? How to get to millions of daily active users, just in general?
Yeah. So first of all, in the past 7 years, we have looked into games that are related to blockchain, crypto, Web3. We looked at 852 deals. We have only invested in one. By end of last year, that is a team built in Steam for Web3 and still going on after two bullish run and bearish run. But the first months of this year, 2023, we just made 3 investment into a Web3 gaming engine for Metaverse, and then another Steam for Web3 esports, or you can say game launcher for social games on Web3. And the last one is a single title game for PvP mobile game. But I have the same impression as you did ever since I played my first Web3 blockchain games called CryptoKitties by Dapper Labs back in 2017. I have spent 2 weeks with all my roommates together to reverse engineer to find out what is the actual metrics formula that can actually nurture a crypto kitty with a Christmas hat during the Christmas in 2017. We realized that, damn, there is even a mutation mechanism in the game. That game to me was actually kind of fun because that was my first time having a feeling, a sense that if I do enough of my homework and if I stayed up late, I might actually earn something from the games. Plus, the CryptoKitties are very cute. But
they are.
When I was playing Steppen, as people say that as the first move to earn game or X to earn kind of project, and Axie Infinity, I feel the same as you just mentioned. That I feel like it is 10% game system content gameplay plus 30% of NFT as tradable assets, and then 60% of DeFi strategy, including crypto staking, yard farming, liquidity mining. So it really a lot. These 3 portions probably define the motivation of gamers that really went into these games. Most people come in for the financial aspect.
Exactly.
And secondary, I mean, for a tradable assets that can potentially help them think that if I bought in from 1 ETH, it might be bought out from another person for 2 ETH or even 10 ETH in a very short amount of time. That is considered very speculative. But I want to give an insight. This is literally copy-pasting an investment strategy by one of our big individual LP of Outliers Fund Street. I might not be able to disclose his name, but
no worries.
You might be able to set up to find out that he is currently the single largest holder of XC, who owns over 300,000 XCs, as well as the single largest holder of Sol Rare. Like when people talk about XC Infinity and Sol Rare, people probably refer it to, oh, isn't the game dead already? Are there still any player playing it? Actually, yes. It's just very little compared to its all-time high was 2 million daily active users back in the first half or Q2 of 2021. So the strategy for this LP of Outliers Fund Street was actually kind of strange. He always trying to find games that have hit an all-time high in terms of its NFT value or in terms of its governance token, such as AXS.
Right.
So for Axie Infinity, its first institutional private pre-sale price was 0.1 ASX, and with a very long vesting schedule. So if there are some crypto media claiming that, oh damn, if you have ever put in $100 in Axie Infinity, you would have made 1,700x from Axie Infinity. That is totally a false claim.
I see.
I have seen the cap table of Axie Infinity. The only 5 investor who got in the first round, 4 out of 5 are accelerator. So they're having the mindset using right of first offer, right of first refusal to actually flip Axie Infinity, no matter equity or token, after their vesting schedule unlocked, which means after May of 2022, which is after Terra Luna crash. So it's nearly impossible if there is anyone who just find the highest big time and then find out the lowest floor price and then say, oh damn, if you have put in $100, you have made how much, several million, and so on. That's actually like a false impression. But there are investors like this guy who would rather like give up the 0.1 to $2 20x growth, and who always come into the game very big by pouring into 50 million to 100 million, and then 3 experts he brought in from Web 1 and Web 2 gaming field to find out those games have once gone very, very viral. But for some reason, the founder's reputation got lost. The community trust got lost. The tokenomics got unbalanced. Or maybe it's part of its smart contract or its bridge got hacked. That actually will make the token price drop a lot. For example, from 170 drop all the way to $2. But as long as the gaming studio is still there, the management team, operating team, R&D are still there, this expert will bring in 3 experts who is very good at rebranding, who is very good at system architecture, and last but not least, who is very good at tokenomics and ecosystem balancing. And so basically, by putting a significant amount of cash into the mother company, taking a board seat, and then putting a significant amount of cash into the token itself, as well as like scooping over 300,000 XC NFT itself from OpenSea. Then basically what his goal, his objective is to make these investments going back to its all-time high.
So he's like an activist investor per se.
Yeah, so he is very active on this and betting very heavily. But honestly, if you look at the numbers, he doesn't need 20 out of these $50 million rebranding Axie Infinity program to work. He only needs 1 out of 20 or 30 to actually work. Then it justifies the entire investment.
So I want to share with you an opinion I have on Web3 games in general and see what you think. So I've seen some games, I feel like they try to shove down their NFTs and tokens down gamers' throats, which is why some gamers may not like it. Like, for example, they have characters as NFT, items as NFT, land as NFTs, and then like 2 different tokens. And people are like, why are you trying to like shove everything down my throat? So what I think is maybe a lighter touch, more like potentially optional approach would work better. Just curious to hear what you think.
So the most common scenarios we see from a GameFi project or Web3 gaming project is they would have an in-game currency that you use to buy your weapons, your character, your skin, your emoji, and so on. And then there is another governance token that actually allows you to participate in snapshot kind of community driven voting to direct which direction this game should be built and maintained forwards. As well as like a security token that is more representing like a stocks, the securities of this game itself. This is maybe the triple like gaming tokens, or if there is a dual token system, then basically there's going to be an in-game currency or utility token plus a governance token. But I agree. I always want to have a intrinsic motivation to challenge the Web3 gaming founders. Why are you using token while CryptoKitties are based on Ethereum and it's one of the most successful games? Is it just another vehicle for you to fundraise if you see obstacles of fundraising using equity?
Right.
And if the gaming founders can defend this idea from at least 3 to 5 different angles, such as we see this game should be directed by the community, not by ourselves, not by the publisher. And then the values captured on the NFT should flow back to its security token. And then we will ask follow-up question, jumping into understanding their real tokenomics and see their actual smart contracts. Many of those, when you ask to this depth, to this far, they are not being able to show anything anymore.
Got it. I want to. So one thing you mentioned at the very beginning is that you guys have been all in on infrastructure, like layer 1, layer 2, that kind of stuff. I have a very specific question I want to hear your opinion on, and it's the discussion and debate, like when there is the base layer and then layer 2 and maybe even other stuff on top, where will the value accrue in that scenario, in your opinion?
That's a very hard question for me. To be honest, I hope there isn't any layer 2 or layer 3. Because it means the layer 1 protocol itself is not robust enough. It's still facing the problem of privacy, decentralization, scalability, security, and maybe gas fee being too high. So that people need to add on like a layer 2 scaling solution in order to fix the compromisation of scalability of the layer 1. Maybe many of the layer one protocols like Ethereum was not even built for GameFi, DeFi, SocialFi, XDR, and the metaverse.
Right.
It is originally built for very simple, smart contract-based transactions,
Right.
such as under which condition I should be allocating how much of Ethereum to my daughter, to my son, to pay its tuition,
Right.
and not allow double spending, making it secure, not need to be super fast, but low gas fee, while secure by decentralized enough kind of validator network. But these days, people generally start to build apps and games and even metaverse application on top of these layer one protocol, and expect it to be more like an operating system in the Web3 computing world. So the ask from these layer one protocols will be a lot. People are putting on a more critical lens to view the difference and competitive advantage of these different layer one protocols. I think the values of these layer one protocols should really be coming from, in this sense, in this new generation of layer one protocols, should really be coming from the applications,
Right.
TVL, users, and the developers who are actually pushing forward these layer one protocols.
That makes sense. So, so if you don't think there should be layer 2, layer 3, etc., does that mean you prefer like Solana, Sui, Aptos, that kind of approach compared to the Ethereum and some other modular approaches?
So again, this is a very strategy-wise question to answer. You can see from the post I made today that we are becoming the largest sponsor of Straight Hacker House and all the Ethereum conference, meaning that I still think that Ethereum might be taking up around 70% dominance in terms of more generic use case kind of Web3 layer one protocol. In terms of the ecosystem value it can attract, in terms of the TVL it can lock. So we are placing a lot of bets on Ethereum and its surrounding infrastructure and its application on the upper layer, as well as Sui. We are sponsoring 12 Sui Builder House this year.
Wow.
Around
Got
everywhere
it. That's
in the world. It's a 3-day program times 12 times in Lisbon, Web Summit, Solana Breakpoint, in Japan Blockchain Week, Korea Blockchain Week, Singapore Blockchain Week, as well as Ethereum Seoul, Ethereum Denver. We try to intentionally connect Sui Builder House before or after those big conferences that would attract more than 10,000 people to
makes sense
to come, and we consider this specifically helpful in the bearish market, because only in the bearish market that a lot of builders and founders would actually want to spend their time doing actual coding, actual building. In the bullish run, most people's attention is very distracted by trading opportunities, those kind of sentiment signals.
Very true. Okay, I want to pivot to my next general area of questioning because we have a lot more exciting topics to get through. So 2022 was a brutal bear market for everyone in our industry, but even for VCs, some of the biggest VCs got hammered, whether it be like Alameda, 3AC, maybe they're not even considered VCs, and like Multicoin even. So you as a VC for a pretty big Outliers Fund, I just want to get your general lessons learned and thoughts from last year.
So I can illustrate this scenario by maybe using an example of one of our most unlucky startup case that they got to us in January 2022, and probably we did our due diligence a little bit longer than expected until April, when we commit to be their first round, first check lead investor after they actually turned down A16Z Paradigm and Pantera. It confront directly with the Terra Luna event. So original plan for this startup is to raise the first round at 25 million post, raise 2 million at 25 million post, raise 5 million at 50 million post, and the third round is supposed to be 100 million. And then very unluckily, the first round was right after Terra Luna crash. The second round was right after Celsius, and the third round is right after FTX Element. So it's considered very unlucky. But still, we helped them raise their first round oversubscribed very fast within just less than 4 weeks. They end up cap table becoming 7 VCs, 3 DAOs, and then 5 individuals who can consider themselves an influencer with over 500K followers on Twitter. And the second round, except us, got in as a second round first check lead investor again. There's a lot of different layer 1 protocols, their foundations, and their ecosystem fund. You know, each layer 1 protocol have their own ecosystem fund.
Right, exactly.
At a 50 million post-money valuation, in the first round, we had no choice. It's not us. The founder have no choice but to lower their valuation a little bit to 12.5 million post. So oversubscribed, and second round at originally planned 50 million. The third round, very surprisingly, we collectively raised at a even higher valuation at 120 million post-money valuation with crypto exchanges, market makers, liquidity providers, and founders that are working on interoperability tools. So this is actually one of my best story and experience when it comes to being a lead investor, helping them design, plan, strategize, and execute from first, second, to third round. We just did our annual report, and to find out, very luckily, in last year, we have looked at over 1,200 deals, and we invested in 60 checks into 13 different companies, meaning that another 3 additional checks are considered second round, first check, lead investor position. And I feel like it feels more solid to meet a founder in the bearish kind of downturn. And also from the founder side, makes them feel we chat a lot about recalling the bloody kind of scenario when we both expect to enter into a hard time doing fundraising in 2022. But in retrospect, they really appreciate that they have met Outliers Fund in bearish run, in bearish downturn. And we also very appreciate the chances of meeting them, not in 2021, not in 2017, but in 2022, which we see how solid the founders are, who can actually think big, but willing to start small and then move fast with them. So very luckily, just very, very, very luckily that the 13 startups that we invest last year, none of them have indirect or direct impact by Terra Luna, Celsius, and FTX Element.
Yeah, that's really good to hear. But I guess I'm just wondering though, like looking at all the bad things that happened last year, are there any things that you and your other partners are going to do differently in the future as VCs, whether it be like due diligence or how you advise your founders? Is there any like major changes you're like, okay, we're going to do this process differently in the future?
I would say we always break down the investment phase into probably 7 different phases, from deal sourcing, deal evaluation, initial investment decision plus terms negotiation, and then due diligence plus reference check. Final investment decision and transactions. Number 6 is portfolio management and value support. And then number 7 is the exit strategy and execution. What is nearly the same is deal sourcing. We still do a lot of founder-driven, VCPE referred, and university research labs, as well as conference events kind of deal sourcing. This is quite the same. Deal evaluation is quite the same. What's materially very different is the number 3 and 4 phase. Number 3 is mainly about terms negotiation. I should honestly say they're in this kind of situation. If you consider now a bearish downturn, investors actually play upper hands than founders. So
exactly,
we know that some founders, they originally planned to have 2 million or 3 million of their first round fundraise amount to be used in the next 18 to 24 months. But because some of their checks were not coming by cash, some of them were given transfers through FTT or BNB kind of coins, then they might suffer from having like a very short cash tranche. In this case, if we sense out this from a very solid team, we will reach out directly to talk about how about we help you do like a bridge round, like a round 1.5.
Right.
Before you structure a very formal official round 2. But after you structure like a round 1, I can honestly share many of those really appreciate this kind of offer by even giving us the same valuation or even lower valuation than their first round raised in last year. And secondly, there are also maybe one of the 3 or 4 co-founders of this Web3 startups are personally suffer from his capital locked in FTX or his indirect exposure to Solana and Terra Luna kind of downturn. When we sense this, we reach out to talk about the possibility of leveraging buyout his common shares or advisory shares.
That makes sense.
So these are something that is very differently, that is not possible during 2017, but is very possible after these a lot of crashes. But also, phase 4 is what I call due diligence and reference checks. Originally, a lot of VC who claim to be doing reference check, they mean by seeing A6 and Z, Paradigm, Temasek, under. This is what they mean by reference check. When they see the logo on there, okay, check. This is what actually happened in 2021 and 2017. But what we mean by reference check is when the founders claim that they have been winning 5 different layer 1 protocol hackathons, do they actually win by the official events, or they win by like a hackathon that have one layer 1 protocol being a sponsor? That is very different. When they claim to be raising funding from Polygon, from Mission Labs, from Solana, is it by like a Solana affiliated funds, by one employee who worked underneath Solana Foundation, or is it officially from Solana Foundation, Mission Labs, the company, or Sui Foundation?
Got it.
And only these, I say this is probably, we were doing these like before all these crashes, but after these crashes, I think investors, not only us, are more cautious in terms of reaching out to any single parties you can claim in the intro call. We reach out to the customers claim to be signing up already. We reach out to the investors that you claim to be having soft commit and hard commit already. And we reach out to those interoperability tools, liquidity providers, market makers, crypto exchange that you claim you have been talking to directly. And I would say traditionally just one sum up out of 10 will incentivize investors to invest already. But right now, if you give us 10 calls to do 10 different reference check for a startup with 10 of its claimed stakeholders, one sum down means a huge red flag, means that nearly this cannot be invested. So like investors right now are raising their bar super high.
Yeah, that makes sense. Especially because I heard like during bull market times, deals were so hot that they wouldn't give you time to do all this due diligence process, right?
Yeah, internally we always joke about a fact that happened several times to our team as well, that a founder would share their pitch deck over to us through WeChat or Telegram without saying anything on Monday, and then paste the second message is his or her Calendly, and then we schedule maybe a call on Wednesday, got rescheduled into Thursday, and then he hop on maybe 5 minutes late, and then hop off like 25, 30 minutes in the call, by saying that if you are keen to invest, you should sign your safe by end of this week and then make your fund transfer no later than next Monday. They basically are giving you a message as don't even think about doing due diligence.
I see. That's not good.
But they are true. They are not cheating you. They really have encountered a lot of dumb investors.
Right.
I'm not going to say from which region or geographical areas, but there are a lot of people who derive their fortune by just putting their money in Ethereum and Bitcoin, or doing some kind of trading, or doing some kind of mining. Like there is a saying in Chinese that if you get your money easily in, you can easily lose it all.
Right. That makes sense.
Which I believe it's in the crypto market.
Awesome. I want to shift gears again to a different topic, keep this conversation rolling. So you actually have a very interesting path to VC, a very non-standard path per se. I was wondering if you could share with us your backstory, how you got started as a VC in outlier funds.
Thank you. This is still a story that I enjoy sharing, even after several hundred times, I believe. So back in 2016, when I was a student at MIT Media Lab, our director back then, called Joe Ito, who is also a big figure in Web3 now, he used to encourage us to set up our own special interest group. So I set up one called Special Interest Group on Sci-Fi Inspired Research, because I see science fiction and scientific facts and technological inventions the same thing. It's just our perception difference. And then I'm very keen on aggregating a lot of students, booking a classroom every Wednesday night and Friday night, talking about how can we push from 0 to 1, meaning from science fiction idea into scientific facts. After we've proven that by publishing a research paper, research article, or patent IP, how can we turn from 1 to 100 by pushing scientific facts into technological ventures or even scalable products? And then one day, one of my best friend, who is a Taiwanese American, one class younger than me at MIT, but 8 years older than me in real life, because he sold a company to Apple before coming to MIT undergrad. And then he reached out to me by saying that, hey, Poseidon, I wanted to structure a deal with it, giving you 100K for you to help me invest in people. I said, what?
Okay.
Like, how is this work? He said, I don't know. I just have a gut feeling that because throughout the last year, all of my most radical minds, solid hands, and friends that have most unique stories coming out of this special interest group that you're organizing every Wednesday and Friday. So I have a gut feeling that you can help me invest this 100K in exchange of not only financial capital, but maybe some even social capital, meaning that he would like to use this 100K to get to know more interesting MIT students.
Got it.
And he offered me like a industry standard saying 220. I asked him back like, damn, can you explain what is 220? I've never heard of it. He said, this is very standard in Silicon Valley. This is called the GPLP structure. I said, damn, like, can you explain again, what is a GPLP structure? So we spent a full night on our fraternity. Him, like, because he already sold a company before coming to MIT. So he definitely knows a lot of venture capitalists, fund managers there. And then he structured basically 100K. At first, I was thinking to use my bank account to receive it. But at some point, there is a lot of community members out of this special interest group that I'm organizing wanted to do the same. So I realized, dang, I might not be able to use my Bank of America to receive this. This will definitely trigger some kind of IRS or tax problem. I didn't even have like social security number. So I look into different alternative ways and find out there is my Ether wallet that I can receive Ethereum. So I ask everyone in my 88 people group to all look into Ethereum. And I'm only accepting Ethereum. I'm not even accepting like Bitcoin or even other stable coins. I only believe in Ethereum when Ethereum was like $6 or $7 US. So within 1 week, there are 40 different wallets transferring to my account over 5 million worth of Ethereum.
Wow.
That is over 800,000 ETH sitting in my wallet. Of course, back then I didn't know that it could someday, like 7 years later, it could worth this much. Otherwise, I would just sit back and not doing. Like that could have been like the best investment fund record ever, but I did. And before I actually jump into doing an actual investment, I was very cautious and anxious, so that I wrote a letter in our Slack group by saying that I don't feel comfortable by being a single GP, and I'm not a professional GP at all. Plus, you guys are not professional limited partners at all. Like, I want to throw a clear line. Like, let's forget about the GP LP dynamics. Let's just say I give up all the management fee. I don't want the management fee. I want to be an admin. I can help you guys book classroom, like how we did on every Wednesday and Friday. And then if we want to pick a very specific area to learn how to do venture investing, then let's say we start from looking at all the projects on top of ERC20 protocol. We read white papers together, tokenomics together. Who knows how to read coding? Jump into, right? Reading their actual smart contracts all together. Then after I post this out in our Slack, like 20 plus wallets request like a swap back. Basically over 3 million. I transfer over 3 million out. It only left 20 students as an LP, and I intentionally adjust all of them into 100K. So all of them are 5% ownership LP in this fund. That is not like an institutional, legal compliant VC fund at all. It is more like a wallet that is syndicated by 20 students LP and me as a solo GP. But we start from there. So in between summer of 2016 to summer of 2017, we have collectively read 880 white papers, tokenomics, and smart contracts. And I reach out to all of them through LinkedIn and email. Unfortunately, only 160 of them took us seriously by replying my LinkedIn message and email. So we got in touch with these 160 and we helped them do 32 different sets of strategic services because we learned how to write smart contracts by reading. So we proposed, can we actually help you do some sort of smart contract security audit before any auditing firm actually established? Can we help you do tokenomics design? Can we help you translate your white paper into Vietnamese or even Chinese? And
makes sense.
These are all for free in exchange of two. One is we got to see all those 160 Web3 startups or crypto startups, how they ship their products, deliver their roadmaps, whether it's consistent with what they have written in their white paper. Secondly, they given us 25K, 50K, 75K, and 100K investment allocation, even though we are not a very structural institutional VC with a fund license back then. And then we decided after 6 to 12 months working with 160 startups, we decided to invest the top 20%, basically the top 32 projects. In the end, 8 projects that are all on the more upper layer, decentralized platform services and application, all return negatively. But the rest of 24 infrastructure level research innovations, like layer 1 protocol, layer 2 solutions, and interoperability tools, decentralized and centralized exchanges, all return very positively. So we made our 2 million into 32.4 million within less than 2 years. And that's why earlier in your question that I told you in the past 7 years, that incentivized us to learn our lesson and then back infrastructure projects more than upper layer, application layer kind of projects. And it is Outliers Fund 1. We did Outliers Fund 2 again for 3 years from 2018 to 2021. And then again, turned the fund into 11.2x. And in 2021, that's considered the first. Outliers Fund 3 is considered the first institutional VC fund with all the legal setup, all the fund license, like third-party auditing and so on. So right now we are running a $50 million Outliers Fund 3.
Nice. What an impressive. So Fund 2 was also more syndicate style, right?
Fund 2, okay. Fund 1 and Fund 2 has a fundamental 180-degree difference when it comes to investment and exit strategy. Fund 1, we have 21 students. When we were all back at MIT, we developed a 43 scorecard, scoring matrix that every Wednesday and Friday, we need to read 5 to 7 different projects and then independently doing some sort of peer-to-peer scoring. Right. That we call quantitative decentralized scoring metrics investment model. But then before we actually start Outliers Fund 2, there is one thing we did in between Outliers Fund 1 and Fund 2. That is, we call Outliers Venture Lab, Venture Studio Program, that we call back and then email the 10 top teams out of 160 that we have worked with, asking them if they are willing to join a venture studio program that is not only free. They don't need to give us any token. They don't need to give us any equity, but instead we give them money. And we brought them from Seattle to Hong Kong, Shenzhen, Shanghai, Beijing, Japan, Korea, Singapore, Taiwan, Dubai, Abu Dhabi, and back to the first San Francisco Blockchain Week for a 300 people demo day. So for Outliers Fund 2, we only invest in these startups that we incubate venture studio ourselves, that we call a more qualitative, deep interaction model with the founders. So Outliers Fund 2, we have only invested in 6 startups that perform extremely good out of these 10 portfolios.
That's still a good rate. That's a very good rate. So I guess one thing I'm wondering is how many of your former classmates are still with you for Outliers Fund 3, or is it kind of different people that you're working with these days?
They're currently wearing different hats. So in Outliers Fund, we only have 8 people full-time in the Outliers Fund team, but we are very proud to have 125 Outliers extended community members who are either serial entrepreneurs working on their first company, second company, third company, or venture partners who are helping us doing technical due diligence on certain areas, or even we share deal flow together, co-lead, co-invest together, and they're limited partners. So we have 50 portfolio founders, 44 venture partners, and then 40 limited partners. Right now, most of my classmates who from Outliers Fund 1, to be honest, they are more on the entrepreneur side. Most of them, after putting in 2016, derived 1.316 million back in 2018. Use that amount of money as their starting capital to start their first ever startup. And to be honest, most of them are not even in Web3. Some of them are doing AI stuff, doing EV stuff, doing biotech, doing even space travel kind of startup.
Got it. That makes sense. So that is such an interesting journey that you had. Definitely not a standard one per se, to starting and leading your own institutional venture fund. So I was wondering if you could share some tips for anyone watching this who wants to be a more official investor, a VC one day. What tips do you have for the young aspiring VCs?
Yeah, I would say, first of all, when it comes to crypto, its actual impact to our everyday common people, I think it comes to democratization. Crypto or Web3 really democratized the opportunity and entry barrier to start a startup doing fundraising, or start a fund and doing fundraising. Traditionally, if, say, the two of us, Kevin and I, are college roommates, and we kind of observe a tech trend, say in satellites, we realize using satellites to do low Earth orbit and telecommunication will be a very big ecosystem and business. So we want to set up a Kevin Poseidon satellite fund.
Okay.
It would take us 1 to 2 years, 100K to 200K at least, if you want to be an institutional, legal compliant, from setting up a fund, acquiring a fund license, setting up a bank account, especially it's very long for setting up a bank account, third-party custodian, auditing from Big Four. That is all before you can actually legally do your fundraising. And as a young guy like us, probably it would take us 6 to 12 months to complete the entire fundraising process. And the initial cost is 100K to 200K. If we decided to use the first year management fee to cover the initial cost of setting up all these, then we should probably be confident on raising 5 million on Poseidon's shoulder and 5 million on Kevin's shoulder. But with 10K NFT collection, with DAOs, with Syndicate.io, this kind of decentralized DAO launching platform. Right now, setting up a United States SEC compliant legal fund, you say venture fund or venture DAO, it only takes us 5 minutes
Wow,
and
that's amazing.
0.0001 Ethereum. So right now, the infrastructure for setting up a fund is way more easier, faster, cheaper than 5 to 10 years ago. Even compared to Republic, AngelList, kind of those who want to democratize private equity fundraising. We're actually democratizing private equity or venture capital fund formation. But
Right.
it will, when it comes to the tips, I would say it will right now depends a lot on whether, like traditionally, maybe say if in a demographic area such as in Taiwan, maybe not counting those corporate VC, there are probably only several tens of VCs, independent VCs funds out there in
Right.
Taiwan. But right now, there could be over 10,000 VC funds out there that claim to be having capital, no matter they have 1 ETH or they have several billion. They can all claim themselves to be an institutional, legal compliant VC fund with the fundamental infrastructure built by crypto and Web3 and DAO in the past 5 to 10 years. But what really helps you stand out can come down to different competitive advantage. First of all, whether you have a very technical domain expertise. Maybe you come from a cybersecurity background and you see that a lot of blockchain Web3 projects are suffering from their security problems. So this fund has a very strategic standpoint that you always start from evaluating the deal from its smart contract security. And this could be like a fund already. It could be the total kind of investment and exit thesis of a fund. Or let's say you have a very specific deal flow because you are a student and you organize MIT Digital Currency Initiative, Stanford Cryptics Labs, or Blockchain at Berkeley. I believe
Right.
if you're a president of these student communities, you can run a fund and raise a fund already. Maybe several million, easy. Because a lot
Got
of
it.
your students underneath in these communities will back you. This is like, if you are kind of structuring your competitive advantage based on your deal flow or deal access, maybe third is your add-on value support. What kind of support you can do to the founders post-investment, not pre-investment. And then last but not least, maybe your exit strategy. Because you already, you worked 20 years at Google. You realize that right now, Google, after they have like asked two of their co-founders coming back to Google, they are currently facing a big AI battle with Microsoft and
Right.
its OpenAI. Right now, Google wants to acquire a huge bunch of firms that are doing speech AI, language model AI, image AI, video training sets. Then you have the big appetite of several big companies that can structure a lot of M&A opportunities. Then you can reverse structure your investment strategy and thesis and area of focus based on the appetite you kind of already know. In summarize, I think for a VC to make money, it comes down to level 1, information asymmetry. Level 2, perception asymmetry. Level 3, add-on value asymmetry. Level 4, influence asymmetry.
Okay.
Let's take Outliers Fund for example. I don't think we have been making any money based on information asymmetry, meaning that we don't like prioritize reading the deals decks from Korea just because we speak Korean, we understand Korean culture, but rather we train our perception to believe that the next bullish run might be driven by Web3 social content, gaming, branding, metaverse, innovative NFT use cases. This is level 2. But level 3 is even if our observation and decision on betting on Web3 gaming from now on is wrong, but still the founders who are backed by Outliers Fund can receive a lot of human capital, social capital, technical capital, besides just financial capital that we are putting in. Then maybe we can still make it back. The number
Right.
4th kind of level is leverage your influence, just like how Elon Musk leveraged his influence
Yeah,
on
exactly.
space travel. That is the most kind of easy money you can make while one or two of your key partners becoming an influential figure in the space that you are investing. But I would say just level 1, level 2, and level 3 is interesting enough for young people to play. At least having these in mind will help you shape and carve out your competitive advantage.
Thank you. I think that's a great framework to think about and very helpful. We're rounding out at an hour now, so I just want to give you thank you so much for joining me. Do you have any final things you want to share with the audience before we wrap up?
Oh, I would say for any audience who might be a little bit boring, suffering from the bearish downturn, maybe using the market as a little bit quiet, it's actual time for you, if you are a startup founders, to build some and then to deep dive into some of the long-term question, hardest problems that you have always been on the back of your mind. Secondly, to build meaningful relationships during this bearish downturn, just like me and Kevin, we get to know each other in this timing. That's why we can sit down, being so calm, taking this conversation in a slow pace, but in a very high quality one. And last but not least, like always, kind of don't forget to live your actual physical reality life better. What I mean by is, I see a lot of Gen Z spending too much time on Twitter, Telegram, and Discord. They enjoy living their board apps avatar or their XC NFT kind of DID more than their real physical identity, or they're living their real lives, hanging out with their real friends and real family in the physical reality since they got into Web3. I don't think that is a very good trend to see, because most of the most successful Web3 VC or founders that I know are enjoying a very good life, doing sports, exercise, traveling, leisure, and learning new stuff every day in their real life. I believe those kind of real life interactions will give you more inspiration when it comes to what you are going to build, what you are going to invest in the next bullish run.
Great tips. Thank you so much. And for anyone who wants to check out Poseidon personally or his fund, I'll leave links in the description.